Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just now to go down to the closing bell, and stocks are sinking here. That's as crude oil prices climb back towards $100 a barrel. And poly market traders, they expect prices to remain elevated, with 59% betting that crude oil ends the month above $90 a barrel. Yahoo Finance's Brooke DePalma and Jake Conley join me now to break down the latest market action. Welcome both. Brooke, we'll start with you. Oil is rising, stocks are falling. Bring us up to speed on the markets. What do you see?
Yeah, right now we're seeing all three major indices in the red. The Dow, the S&P 500, and the NASDAQ down more than 1%, with the NASDAQ down nearly 2%, down 1.6% as we make our way towards the close. And what this continues to be is really a market that is so fixated on the price of oil. We got the CPI print. We got the jobless claims. Tomorrow we'll get consumer sentiment, and I can guarantee that this market will continue to be focused on that price of crude as we've seen over the past 2 weeks.
So Jake, the issue is you don't know if you're an investor how long the war lasts.
Right.
You don't know how long the oil disruption lasts. So how are you supposed to navigate that?
It's tough, right? You're seeing a lot of people try to say, look, if this lasts a week, maybe we get here. If this lasts a month, maybe we're in a totally different scenario. And nobody knows. You see President Donald Trump coming out and saying that we're going to end this war quickly. At the same time, you see Secretary Hegseth, others of the administration saying, no, this is a fight. We're going to fight till the end. President Trump has even made comments on that side of the divide as well. And so for investors,
yeah, to your point, it's a very good point, Jake, you're making, because if you're looking for a timeline, it's tough. Exactly. As you know, because Trump initially will say like 4 weeks, and so you're thinking, well, maybe you're roughly 2 weeks out, but then he'll also say, listen, we're going to finish the job, I think is how he puts it.
And when he said only 2 to 4 weeks out, the market recovered, and then it immediately fell back down. But again, this isn't just U.S. stress. If you're a U.S. investor saying, okay, the S&P's underperforming, maybe I should get out and look at international stocks. International's hurting too. Over the last 5 days, the Euro stock's down 0.5%. Nikkei, all these Asian importing economies, the Nikkei down 1.5% over the last 5 days. The Kospi is flat after being up 60% over the last 6 months on the semiconductor industry. But those industries are going to get hurt by the need for energy that they now can't get.
Yeah.
This comes down to the Strait of Hormuz. I mean, to put it simply, right? How long that critical artery stays closed, Jake. Just remind us, why are we so focused on that? Why is that such a critical artery?
This is the single most important artery for oil in the world. Roughly 20 million barrels per day of petroleum products in a normal time go through that strait. It's a huge amount of oil. Now, most of that goes out to Asia, which is why you see a lot of these Asian economies really hurting right now. But if you think about the strait, it's a waterway about 21 miles wide, so it's not very big. A ton of tankers go through there every day. It's really the only main artery to get Persian Gulf oil out to the world. You have pipelines that go to the Red Sea. You see Saudi Arabia now trying to boost up how much it can push through those pipelines, but that's capacity constrained. If you want to move volume out of the Middle East, which is producing a lot of the world's oil, it has to go through the strait.
And what is the latest there in terms of threats from Iran?
You see this getting worse and worse. We were talking yesterday, 14 vessels had been attacked at least. Now that list is at least 16 or 17. You see attacks on ports in Oman and other countries in the region. The fight is escalating. Up until a few days ago, energy infrastructure had kind of been left off the target list because it's such a big deal. It's such a red line. That is not true anymore. Ports, production sites, refineries, you see all these force majeure declarations. And all the strategists I talk to tell me this is not something that if this were all to resolve tomorrow, you can just go back to normal. This is now weeks to months to maybe a year of dealing with all this damage before you get back to a normal market. I want to bring up here, Goldman just bumped their price targets up for the third time for Q4. They're now looking at an average of $98 a barrel on Brent through March and April, falling to 71 by Q4. Now, if you had asked Goldman in December what they thought oil was going to be at the end of the year in Q4, that would have been much, much lower. Remember, we were all saying we're oversupplied. that picture has totally changed.
So, Brooke, when oil prices jump like that, your attention turns to the consumer, the engine, of course, of our economy, and what it means for them, and prices at the pump. What are we hearing from different retailers, airlines? How are investors thinking through that?
Yeah, well, certainly the price of oil, the price of diesel really does affect everything. When you think about just the prices that Americans pay at the pump, that is a direct correlation to how they're thinking about the way things are going in the U.S. economy. And what economists are ultimately telling me is that this sustains above $100 per barrel for quite some time. Even reaching maybe $200 a barrel would be an extreme scenario. But as long as this stays higher, then Americans will continue to feel the impact and maybe think differently. And what we're hearing is from multiple different retailers sort of weighing in about consumer sentiment. Now, Dollar General was out with earnings today, and largely what they said is that this is leading to sort of a cautious guidance. There's so much uncertainty out there. What we heard, though, from Dollar General's CFO today on the call is that in terms of headwinds, we're watching the changing tariff environment. Did we forget about that? Hello? We're also watching the potential for the changes in higher gas prices. And so when they think about a consumer going out, consumer spending, that could have a direct correlation, maybe even going more to the dollar store. We know that higher income shoppers have been shopping more at Dollar General already. So what does this mean for them? You would think better than expected outlook. They chose to go with a more prudent approach.
By the way, here was another headline I want your take on today. And this was from the Energy Secretary, Chris Wright. Telling CNBC in an interview, the U.S. Navy is not ready to escort oil tankers through the Strait of Hormuz. Here's what he said. It'll happen relatively soon, but it can't happen now. He said, we're simply not ready. All of our military assets right now are focused on destroying Iran's offensive capabilities and the manufacturing industry that supplies their offensive capabilities. What did you make of that headline?
It's going to be bearish for the market.
Yeah.
One of the signals people have been looking for is that the U.S. Navy was going to be willing to say, look, if you need to get oil out of there, we will put a warship beside you. We will guarantee that safety. You saw President Trump say that in a Truth Social tweet last week.
And as soon as he said that, you saw the stock reaction jump.
Exactly. Yeah. You saw the stocks react positively. Oil prices came down. We're going to do security guarantees. We're going to provide insurance. None of that is clear yet. Chris Wright, as you point out, saying maybe by the end of the month, we're ready to start putting resources there. But for the market, that says another month of disruption. And if you talk about fuel, gas, oil prices, another sector to look at airlines. Airline stocks are getting rocked right now because they need to guarantee the price of their jet fuel stays at a certain margin. Jet fuel is double where it was. And if you look at the American airlines, especially American, Delta, Southwest, the European airlines hedge oil.
Right.
They buy contracts out ahead. They guarantee low pricing. The U.S. airlines really stopped doing that in the mid-2000s, around 2008, around the recession. That means they're completely exposed to these prices, and the consumer is going to feel that too, because where does that price get passed on through? Ticket prices for a seat on the plane.
Right, and right now we're hearing projections that those ticket prices could rise 8 to 9%, maybe even 10%. Some people are impacted. And we even heard from United CEO, who said that this could be a direct correlation pretty quickly because of the fact that they don't contract out, that it basically is day of. They're constantly fueling what the cost will be.
And these prices go up so fast, they come down so much slower. You see the same thing at the pump. Gasoline prices, as you were saying, Brooke, absolutely spiking in this country. But you talk to any gasoline, gas pump analyst out there, they'll tell you the same thing. Prices go up much faster than they come back down, which is going to be a stressor, especially heading into the midterms.
Yeah.
Brooke, what do you think the Fed makes of all this?
Well, right now, based upon how this will go, it's certainly they're trying to weigh two different mandates here. This is going to push inflation higher. And sure, in the next month, we'll be looking for that energy prices to see how much of an influx this has caused. But then months later, we'll then see the impact on goods, apparel, everything else, because those diesel costs are going to be higher. That's going to cause it to be a higher price in order to transport all these goods. And therefore, that could drive inflation higher. Now, one economist that I spoke to said, if we get to 3%, then the Federal Reserve will ultimately have to raise rates in order to offset that. But ultimately, what we're hearing is that this is a Fed that will sort of wait and see how this all goes. And so that can mean the meeting that soonest we'll continue to see status quo. We won't raise rates or cut rates anytime soon.
Look, I bet you don't want to be Kevin Warsh right now.
100%.
Looking at this, right? Because the president is going to be wanting him to cut rates.
Right.
And the risk, as you're saying, that the Fed's going to run, especially if the energy prices that are going to push headline inflation up, if they start bleeding into core inflation, the Fed's going to be in a position where they almost have to hold or maybe even raise.
Means, Jake, it means as Brooke said, wait and see. It means what we thought they were going to do anyway. They're just going to sit on their hands for a while, right?
Right. You see all of Jay Powell's messaging for how long going back. We are going to be cautious. We're going to wait and see. You see several of the governors coming out recently and saying, look, it's too early to get a read on this. We need to see how this bleeds through. But you also have to know Kevin Warsh is going to be getting, if he's confirmed, is going to be getting pressure to cut.
Yeah.
And that's going to put him in a very tough position as the head of the Fed.
No. Once you see 3%, all hands up, everyone's going to be questioning what do we do now, especially with that weaker than expected economic data.
You can't let inflation run away.
Yeah. All right, Brooke, Jake, thank you so much. Appreciate it. And you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. Wall Street is also watching closely the state of the labor market and the risk of AI disruption on jobs. Just today, software company Atlassian announcing plans to cut 1/10 of its global workforce because of AI. Mizuho has also released a note that says office jobs are coming under increased pressure as the impacts of AI take shape. The note's author, Vikram Malhotra, joins me now. He is Mizuho's America's senior analyst. Vikram, it is good to see you. So listen, we know lots of debate and discussion about this topic, how AI, Vikram, is going to impact jobs, especially white-collar jobs. Your report suggests office jobs are under some pressure here. I guess, is that, Vikram, did you look at that and say, okay, that's AI, or that's companies maybe trimming excess from the pandemic boom, or maybe it's a little bit of both, Vikram?
It's a fair question, and thanks for having me. Yeah, I think it's a bit of both for now. Look, if you step back and think about 2000, call it 20 through 23, certainly we were in a lower rate environment. Companies were growing pretty fast. So there's likely excess fat that got created. And now perhaps some of it is being reversed with AI as an excuse, if you may. But the anecdotes do suggest efficiency is higher. What 3 people can do, perhaps 1 or 2 can. So I think it's a bit of both, and I think we'll keep seeing headlines over the next 6 months.
One interesting data point I thought in your report, Vikram, that stood out to me, software job postings, those are trending higher, it looks like, right? But actual jobs, you point out, those look to be declining. So what is going on there? What is that disconnect? I mean, is that, Vikram, is that a CEO posting jobs, then it's like actually maybe AI could do a few of these? I mean, just explain that for me.
Yeah, it's fascinating to me as well. I mean, there was a bullish investors were pointing to sort of the software postings going up. Now, remember, these postings could be 6 months old. They could be 2 weeks old. It's a amalgamation of various postings. The actual jobs actually tell you a different story. And if you really dig down by geography, you will see a lot of that is in the West Coast. And what I think is happening is the conversion rate is clearly changing. So while there are more postings, the type of a person that's filling that role, I would say the bar is getting higher and higher. And essentially, if you think about it, if there were a team of 5 and now you need a team of 2, those 2 people have to be very, very good to do that same job. And that's what I think is starting to play out. That conversion rate from posting to actual job is changing.
Another takeaway, Vikram, from your report, it looks like finance and legal job postings holding up relatively better than tech roles. Why do you think that is? Are those maybe somewhat more AI resistant, Vikram?
Well, certainly happy that finance jobs are holding up better for all of us over here. But look, I think the SaaS software complex is in the firing line. Clearly, all the innovations we've had from AI, coding is the number one area that can be a lot more efficient. I think when it comes to finance, we were already fairly thin. If you think back post the GFC, we did pick up hiring, but many teams are lean. And that's why I think we're continuing to see more of a pickup in finance. But it is slower adoption by a lot of service-oriented firms, whether it's finance, whether it's consulting or legal. And so I think it's a bit of potentially a domino effect, potentially an adoption. If you actually step back and look at the US versus other countries where the adoption per capita stands, we're actually not number one. The US is number one in terms of absolute numbers, but countries like Israel, Australia, Singapore, per capita, their adoption of AI is actually faster. And so I think it's going to take a while for this to play out.
Vikram, if white-collar work or some white-collar work shows signs of weakening, More broadly, what does that mean for the office real estate market, Vikram? And are there certain cities you would argue, hey, these could be more relatively at risk than others?
Yeah, it's a great question. So the thesis since, call it October, has been support jobs, back office jobs, largely thought to be in the Sun Belt, are more at risk. And that's why you've seen office REITs, particularly Cousins and Highwoods Properties, underperform since September. Our work, we actually authored a report prior to this called AI Revolution or Evolution of Jobs. And essentially, our thesis is that when you look at jobs by function, there is greater risk to not only to white collar, to higher paying jobs, but also coastal jobs. You just mentioned legal, finance, accounting. You could definitely see a lot more efficiencies. And when you drill down to what it means for the REIT, REITs faced a very tough time during COVID. A lot of management teams have done a fantastic job bringing occupancy back up, but we're still not below what I'd say the tipping point is. And by that, I mean when New York vacancy is below 10%, you actually have pricing power and cash flow growth. We are now, for New York as an example, sitting at 12.5%. And our thesis is a small change in job growth causes a structurally higher vacancy level. And if you're sitting at 12% on a 5-year basis, it means much, much lower cash flow growth. And that calls for lower multiples for the office REITs.
So let me end there, Vikram, because you know office REITs, you know that sector. Are there certain REITs, Vikram, where you would argue, listen, these names are relatively better positioned given the backdrop, the environment we're talking about here?
Yeah, it's an interesting question. So I definitely think Cousins within the office complex is better positioned. They have a quality portfolio, very strong balance sheet. I do think they can grow cash flow, and I think they've unfairly been negatively impacted by this thesis that the Sun Belt markets like Austin, Atlanta have only support jobs. I mean, you'd remember 20 years ago, all those support jobs went to India and the Philippines a long time ago. So when you dig into a Cousins portfolio, there are actually a lot of frontline jobs servicing local communities and regional communities. So we actually like Cousins. It's one of our top picks for this year. If you step out and look at other asset classes, from a positive standpoint, I think healthcare could potentially benefit a name like Welltower, where they have a sizable exposure to labor through their senior housing business. And if you argue there's more unemployment, one, they could, with AI, reduce the number of FTEs they have in their senior housing operators, but also perhaps lower their labor costs. And so I would say if our thesis plays out, there's lower structural job growth, more unemployment. The flip side would be many of the healthcare names can benefit.
Vikram, great to have you on the show today. Thanks so much for your time.
Thank you so much.
Coming up, we talk through the latest housing data. That's next on Market Domination. housing market data this week showing a relatively sluggish picture for the sector. Join me here for more on the stories we're watching. Let's welcome in Yahoo Finance's Brooke DePalma and Claire Boston. First up, a look at mortgage rates as it sees an uptick amid global concerns. So Claire, mortgage rates rose this week to above 6%. According to Freddie Mac, your 30-year fixed mortgage rate, it looks like jumped 11 basis points to 6.11 for the week ending on Wednesday. What do you make of that? Where do you think that heads from here?
Yeah, I mean, unfortunately, I think all signs, at least for now, point to higher, which is not good news. But what we're basically seeing here is that this is all this Iran issue. People are worried about oil prices, they're worried about inflation, and we are seeing that reflected in treasury yields and mortgage rates. I really do wish I had better news because like this is spring home buying season, but
it's really rough for Brooke, who's looking for a home.
It is tough out there, guys. And they tell us exactly. The realtor we're working with, she keeps telling me that there's going to be more inventory on the market.
When does she say that's happening?
May. April 1, yeah. But what I'm hearing is at this rate, I mean, how much we're going to buy houses
what do you think,
in the New York area?
More inventory coming in the spring?
You know, I hope she's right because we really don't have any inventory right now.
But what do you think if you had to place your bet?
I think it should be better. There is normally a seasonal pattern upward, as Brooke said. April, May, those are the better months.
But what I'm hearing from executives like Lowe's CEO is that nobody wants to move out of their house, Josh.
Yeah.
Everybody is staying because why would you trade a 3% mortgage rate for a 6% mortgage rate? I don't blame them.
3, what kind of sense does that make?
And that's the lock-in effect.
Yeah. How about this? Thought of you when I saw this. More housing. This article in the Journal. Here's this. Americans are reconsidering adjustable rate mortgages, Claire, as a way to cut the cost of buying a home in the short term, right? So the Journal puts it like this. The loans faded from popularity after helping fuel the 2008 financial crisis, but persistently high mortgage rates, Claire, have more home buyers turning to arms. What do you think of that?
Yeah, so that is something we have seen in the data. And basically, the key here is that you can get a cheaper rate than that 6.1. The typical 7-year ARM right now is about 5.7. So pretty significant savings. And the people who do this, maybe they're people who want to move in less than 7 years and they don't want to pay a higher rate. It's also people who are just betting that rates will fall within the next 7 years, which that's a long time.
Is that a riskier bet?
I mean, it definitely depends, right? We do have some people who maybe took on an ARM 5 years ago. They're not feeling so great because let's look at what rates have done. But 7 years is a long time. It's also a way for people in those really expensive homes to just get a cheaper mortgage.
Right.
How about this one, Claire? More housing, because we've got more housing. Housing starts. Single-family housing starts fell 2.8% in January. How much of that was, that was a rough winter. Was that weather, something broader? What did you make of that?
Yeah, so I think weather is definitely a component. We had, at least in the Northeast, we're having the coldest winter in 10 years. That being said, we're not completely surprised because we saw permits, which is the step before starts, those have been falling. And the builders are just kind of pulling back because weirdly, there is an oversupply of homes in some markets, especially the Texases and the Floridas of the world. Brooke, like you were saying, prices are really high, rates are pretty high, buyers are staying on the sidelines, and builders cannot find enough buyers, so naturally they're building less. But now, it's not good for the long term.
At the same time, what I did hear from Lowe's CEO is that people are reinvesting in their home because this home equity right now, as we heard from President Trump during his speech not too long ago, people have upwards of $400,000 worth of house equity, so they're doing some renovations, is what Lowe's CEO told me. At least that's the hope here, is that they'll invest in their home that they're ultimately staying in. Are you hearing that too?
Yeah, so there is some sense that, those locked-in people we were talking about earlier, if they're going to make the home that they're stuck in fit their needs by renovation.
Right.
However, the issue with that is that a lot of renovations are done either immediately before or after a move, like you're getting your home ready or you moved in and you want to make some changes. And since people aren't moving, that is a little bit of a lag on some of those earnings.
Yeah, they're not doing a major addition. Yeah.
Claire, you mentioned Florida a moment ago. Here's another Florida headline. Florida, Claire, now dominates the housing risk list. It now has the most counties at risk of home price declines in the country. This is per Realtor.com. What did you make of that? Is that sort of can we chalk that up to pandemic boom unwind? Is that what that is?
I think so. So, Florida has been a sort of problem state for housing prices for a couple of years now. They rose really fast during the pandemic. Builders rushed to come in. Eventually, people stopped moving there. We had just less mobility as people went back to work. And there is just a glut of homes there. Another issue in Florida specifically, insurance costs. They are out of control.
With hurricane and weather.
Definitely.
Impact.
That, if you're kind of going the condo direction, there were some legislative changes.
were just talking about Miami yesterday. How great that sounded.
We certainly were. We were talking about in the context that so many billionaires are moving there to avoid the tax impacts that we're seeing in California and Seattle and
because
so
Larry
on.
Page insurance cost, that's not really an
Yeah,
issue,
I just don't think that like Jeff Bezos
that's
is
not
worried
top of
about
mind for
that.
Zuck.
No, but for the regular people, those insurance costs are going up, their HOA fees are going up. It just makes it a little bit less palatable to be down there.
And I think this kind of speaks to the K-shaped economy we're seeing. The high-income consumers, like Jeff Bezos and maybe Howard Schultz, who recently moved there, are able to put up with these higher costs, whereas the everyday person is really struggling. We're seeing that insignificant increase in foreclosures, perhaps.
There literally is no cost they can't put up with.
There is, as we're hearing.
By the way, so Florida, okay, but then Claire, I thought this was in that same list. They say the Midwest. That's just the opposite, right? That's the opposite. Those are some of the safest housing markets. Did that surprise you?
Not really. So the Midwest has been kind of this like sleeper leader in the housing market. Some of it is that they are not building homes. And the other reason is that people from these kind of high cost coastal areas have been moving to the Midwest because to them it is cheaper. So there's a lot of demand for housing, not a lot of supply. And what do you expect?
Is that where should I be moving to the Midwest?
I mean, Chicago's really lovely. I don't know how you feel about
the colder winters. I don't know if I could take it after this one. All things on the table.
By the way, second worst after Florida, my home state of California. And who comes in third?
New York.
New Jersey.
Oh, New Jersey. Okay.
New Jersey ever stay off any of these lists? I haven't seen it yet. All right, third topic. This is interesting, Claire. So this is a Washington Post op-ed. Get your thoughts on this. And they're basically talking about how elevator rules are kind of throwing this wrench in our housing market. This is a 1988 law making housing less accessible, driving up prices. You read that story. What did you make of it?
Yeah, so the gist, just to summarize here, is that the US has really strict regulations about elevators, how big they need to be, and it makes the elevators a lot more expensive and larger than they are in places like Europe. And as a result, builders just don't want to build them. Sometimes they are not building houses at all, and sometimes they are not including elevators, which is a big accessibility issue. And so I think this is a good example of how a regulation might have a good intention, but just not quite work out in practice or end up affecting the housing market in just a weird and different way. And so I'm not sure that there's like any push to really change this, but it is an issue that we can look at how we do it versus how places like Europe do it, and we see a difference.
Was really, Claire, that was really the cost here and the differential between us and what's going on across the Atlantic. Elevators for a small building in France or Germany cost around like 50 grand after adjusting for cost of living differences, I guess. They typically take up like 30 square feet, this is according to the Post, on each floor. In the US, they can push 200,000 and they consume like twice the amount of floor space. So I guess it's no surprise a lot of developers look at that and said, forget it, I'm axing the elevator.
Yeah, absolutely. And specifically with these elevators, we're talking about what we call like the missing middle housing. So that is like putting townhomes or like a medium-sized home in an urban infill area. And there's a lot of evidence that these are the places that people really want to live. And so when we don't build that stuff, it has consequences for housing prices in these sought-after neighborhoods.
Yeah, good point.
Yeah, and you see the difference between like a townhouse in New York City versus this huge elevator building with 3 different elevators, and just those prices for some of those apartments are skyrocketing. It feels like rent, even though it's come down a little bit, still high.
All right, Brooke, Claire, thank you both. That was great. Appreciate it. Coming up, Shark Tank's Daymond John joins us next. Don't go anywhere. Investments in data centers, energy, and manufacturing is bumping up demand for skilled labor in the U.S. And Shark Tank star Daymond John is joining forces with a grants program to help fuel growth and innovation for the blue-collar worker. Shark Group CEO Daymond John joining us now. Daymond, it is good to see you as always. So let's dive into this, Daymond, because you're working with Jobber now on these grants for skilled trade entrepreneurs. That is interesting. Walk me through what that means, Daymond, how this just came about. And do you look ahead, Daymond, and say, hey, you know what, maybe 2026 is some kind of breakout year for blue collar and trade careers?
Oh, absolutely. So thank you for having me and always supporting any initiatives I have. I decided to partner up with Jobber, who basically is the CRM for all of these small and or large blue collar or skilled trades, such as plumbers, HVAC, and things of that nature, electricians. And I think this trend has already started about 2 years ago. We're looking at, as you opened up with, data centers and construction and various other things. There's about $7 trillion set to go into this market by 2030. And we're going to need more of these type of skilled workers as AI creates more of a need for electricians, and more people are wanting to stay at home because of, as you were talking about, the interest rates. They want to make where they live right now a better place, and the average home is 40 years old.
Daymond, there was one stat from Jobber that I thought was so interesting. I don't know if you saw this one. They say only 16% of parents, 16% of Gen Z believe a college degree guarantees long-term security. That ain't much. I'm just wondering, do you hear that and say, hey, maybe, are we going to see a real shift here away, toward trade and entrepreneurship, Daymond, and away from higher education?
Parents are smarter than I thought. I thought would be about 50% would say that, but the data is showing that between 50 to 60% of the kids graduating college today will actually retire with a job title that doesn't exist today. So how do you go out and get student loans? It could be $500,000, $700,000 worth of student loans for a job that won't necessarily exist in the future. So I do think that it's where we are today, because you can get right into a blue collar career, out of high school immediately, get paid $100,000, $150,000, $200,000. And, I was talking to somebody the other day and said, I don't want my son to be a plumber the rest of their life. Well, you know what? Your son learns how to be a really great plumber and see how to improve the system, and can roll up 2,000 plumber, businesses of these baby boomers who don't have their kids who want to take over the business. That son is going to be a pretty wealthy, or daughter, a pretty wealthy person.
Daymond, when we think about blue collar work, I'm also curious to get your take about how that could be evolving. Again, citing Jobber data, I thought it was really interesting how they broke out how many service companies are already using AI, for example.
Yeah, absolutely. That job is evolving, because with the advent of AI, well, you don't necessarily need a lot of the paper processing, the legal, and the teams that you may have needed, the social media managers and various other things. You can do what you do best: serve people, solve their problems, and be of service. And a lot of these other things are now really right there at your fingertip. And that's exactly why Jobber is such a great business, because it takes a lot of that admin work you would normally have to do. It takes it, out of the system, and you don't have to deal with people.
Switching gears, Daymond, you invest a lot, of course, in consumer companies. So you have very unique line of sight there. I'm just curious, as you talk to CEOs, business owners, entrepreneurs, what are you kind of broadly hearing about the American consumer, Daymond? How healthy, how resilient?
Well, the American consumer is changing. Luxury goods, if it was, a great luxury company, they may be doing okay, but everybody else is really suffering. You look at TJ Maxx in Burlington. I think TJ Maxx has performed around 19% annually for the past 20 years, because a lot of these goods are not being consumed the way they were before, and now they have to go to off-pricers. And the way that people are shopping today, they're really shopping for experiences more than anything else. We're in a very visual world. But live selling is becoming the strongest thing that anybody can do, whether it's TikTok Shop, whether it's Whatnot. These are the platforms, and people don't realize, I think QVC has 4 of the top live selling TikTok shops right now. So the way that they're consuming is changing. You have to have an experience that's added to it, and you can sell direct to the consumer now, and you don't necessarily need the traditional brick and mortar retail.
Daymond, the retail industry, which obviously you know very, very well, cheered that recent Supreme Court decision striking down some tariffs. And I'm just curious, Daymond, when you're talking to retailers, what are they saying about what comes next? You know, what that means for their bottom line, for pricing, for margins?
Well, it's a gray area. You know, the big box stores, they're not going to change, how they buy the goods. If Walmart wants it at $9.99, well, you better deliver it at $3, $4, $5. If not, there's somebody in the parking lot ready to eat your lunch with a bigger smile at a lower cost, right? So they're not going to change. It's going to really affect the everyday individual business because, it's volatile right now. Is the manufacturer going to take on that cost? Are you going to start making it in the U.S. or another country? So that's where the problem is going to really affect the everyday, entrepreneurs that are selling to these companies.
Finally, Daymond, I got to ask you this one. Man of high fashion that you are. I saw this story, Daymond. I knew I was going to be talked to. I said I have to ask Daymond about this. Did you see this? The 10-year-old kid, Daymond, I don't know if you saw this, 10-year-old, showed his collection at the Paris Fashion Week. He's 10. Max Alexander presented his fall winter line at the Paris Fashion Week. He is the youngest designer known to do it. You know retail, you know clothing, you know fashion. How blown away are you by that?
I didn't know about this, and I'm actually shocked, and I'm sure he won't want to come work for me now, but it sounds fascinating, and I think that he probably got recognized by some of the stuff we were just talking about, by building his own platform and showing his skills. The power is within the hands of the people these days, so this is absolutely amazing.
Our man Max has been sewing and designing since he was 4. I was not sewing and designing at 4. I don't know about you, Daymond.
I was barely walking by the time I was 4.
Daymond, as always, so good to have you on the show. Thank you, sir.
Thank you. Make sure everybody goes and applies at jobbergrants.com. It's $100,000 free money.
Great to see you, sir. Thank you, Daymond.
Thank you.
Coming up, we look ahead to Nvidia's GTC conference. That's next on Market Domination. Nvidia is gearing up for its flagship annual chip conference next week. Let's look at the vast array issues and announcements investors are expecting to hear more about. Joining us now, we got Nvidia's Senior Director of HPC and AI Infrastructure. That would be Dion Harris, as well as Yahoo Finance's Dan Howley is also with me. Dion, it's great to see you. The big conference, Dion, it's just days away now. What should we expect, Dion? Will it be as exciting as prior years?
Well, like you said, just days away. We're excited. It is officially the Super Bowl of AI. And of course, we'll have our incredible pre-note or pre-game show featuring lots of thought leaders describing what's happening in AI. And of course, the keynote will unveil all of our great announcements and really celebrate our ecosystem and how we're working to advance the state of the art.
Yeah, Dion, this is Dan. Good to talk to you again.
Yeah.
I want to ask, obviously NVIDIA's had a lot of deals recently, whether that's with the optics for networking or with OpenAI, that deal announcement. Are we going to get more kind of clarity on those kind of announcements, how they fit in to NVIDIA's kind of long-term vision going forward?
Yeah, I mean, NVIDIA has been incredibly transparent about what is our strategy and view of the entire ecosystem. In fact, Jensen published a blog earlier this week on the 5-layer cakes of AI, and the first layer is energy. So we're going to talk about all the work we're doing across the entire landscape and ecosystem to help deliver more energy to power AI. Of course, chips, that's what we're known for. We'll have lots of great announcements describing all the new late-breaking technologies and chips that are going to power AI. And then on top of that, we'll talk about infrastructure. Most people don't think about infrastructure, but in terms of how you power, how you cool, how you deliver AI at scale is really the next challenge for how we get to that next level of AI intelligence and performance. And then some of the investments you talked about in terms of model makers, incredible work happening there at that layer in terms of advancing the state of AI, delivering the highest intelligence per dollar, the lowest token cost and lower energy consumption per dollar. But more importantly, it's that fifth layer that I think we're really excited about, which is applications. All the ISVs, all the vertical applications that are now adopting and leveraging AI. Of course, we're in the midst of this, agentic AI explosion. So we'll talk about all of those layers of the cake. And of course, we're innovating at every layer to make sure we can deliver that future that we've talked about.
Yeah, I mean, you guys have kind of discussed how you see yourselves more as a software company than a hardware company in the past with, you have obviously the open models, Nemotron, things along those lines. And a lot of kind of the open source technologies have started to really kind of take hold across the globe, really. I guess, how do you get folks to really grab that message and kind of agree with it, right? Because whenever we talk about NVIDIA, everybody thinks about the chips, but NVIDIA is saying, yeah, we have chips, but we also have this large array of software.
Yes, and that's a great question. And it goes back to what I just described. NVIDIA is an AI infrastructure company. Of course, we have chips, and that's really where sort of the core IP and sort of legacy and leadership started. But all of that has really sort of been advanced to what we call extreme co-design. Obviously, we're building out the chips, not just the GPUs, but the CPUs, the networking, DPUs, data processing, all of those different chips and hardware components come together. But there's a ton of work that goes into our software to make sure that infrastructure runs efficiently. And then, like you just described, we're also building models to make sure we understand not just the infrastructure, but the actual applications themselves. And that, again, has this virtuous cycle of allowing us to build better hardware, which in turn creates better software and better models that powers that full AI infrastructure stack.
I want to ask one last question, just from me about robotics. Jensen said that it's a multi-trillion-dollar opportunity in the past. We've seen the little Star Wars guys come out on stage and kind of do their jazz. Recently, it's been we've seen a lot of announcements around the data center. Obviously, that's the bread and butter of things. When do we start to see kind of the robotics really start to take hold for NVIDIA going forward? Is it a matter of other companies kind of stepping in and saying, okay, we've got the products, we can start moving forward, or is it a matter of you guys kind of pushing them forward?
Yeah. Well, again, NVIDIA is a platform company. And so, of course, we build platform for different technologies, different verticals. And you can expect to see a lot of incredible announcements around robotics. In fact, if you go back at a couple of keynotes ago, when Jensen sort of laid out the trajectory of AI, he talked about generative AI leading to agentic AI, which now brings us to this next wave, which is agentic plus physical AI. And so, again, the embodiment of AI in the physical world, physical space, you'll see a ton of incredible announcements, not just humanoid robotics, but of course, autonomous vehicles, which is another form of physical AI. So all of these things are coming together at GTC, and you'll see a host of robots. You know, you might see some surprise appearances on stage, but more importantly, all of our partners will be there celebrating the work they're doing on our platform to deliver against this vision of physical AI.
Dion, one question I bet NVIDIA investors have. When do you all think, Dion, individual companies and governments, when do you think their data center spend, Dion, could one day overtake the hyperscaler spend? How do you think through that dynamic?
Wow, that's a good question. I wish I could give you a specific answer, but I think what we're seeing, and this is playing out in terms of just what we're seeing with our customers and partners, most customers are recognizing the value of AI. As we talked about before, as AI has transitioned from models to applications, now you're seeing it embedded in companies like ServiceNow, like SAP, like Siemens. And so as you make that transition from AI models to AI-driven applications, you're going to see a proliferation of industry and enterprise-driven use cases. And of course, they'll need to power that on infrastructure. Some of that will be on on-premise-based systems. Some of it will be in the cloud, leveraging a lot of our advanced technologies like confidential computing to make sure they can have the security isolation performance required. But the key point there is that as we move from AI models where you have millions of users to AI applications where you have billions of users that are accessing and using AI through applications that we use every day, that's really what's driving that huge shift. And then, of course, there's also the transition of AI workers. Right? In other words, as you see enterprise platforms now embracing agentic, we're kind of in the midst of what I would call an open claw sort of inflection point, right? Where you're seeing these agentic tools and tool chains starting to evolve very quickly to enable lots of enterprise work to be done by AI digital workers in conjunction with the infrastructure that's required to power that.
Dion, Dan, thank you both for your time today. Appreciate it.
Thank you.
Also this week, Dan Howley got his hands on all of Apple's new products. Let's take a look at that.
People have been asking for it for years, and Apple has finally done it. They have a MacBook for everyone. This is their newest, the MacBook Neo, and it's $599, powered by Apple's A18 Pro processor. That might sound familiar if you've been following Apple for a while, because it's the same chip that's found in the iPhone 16 Pro and Pro Max. That's right, this is running on an iPhone chip. It also has 256 gigabytes of storage. You can upgrade that for an extra $100. You would also, if you did that upgrade, get a Touch ID sensor on here. This is a great option. We have on the side, purposefully, a headphone jack. Apple said that they did that because this is meant for classroom use as well. And so a lot of schools use wired headphone jacks because, I mean, let's face it, they're less expensive than a pair of AirPods. There's also two USB-C ports on the side. One allows you to output to another display so that you can, view more content, things like that. Overall, I mean, for $599, you're getting an incredibly well-built device. Usually in this price range, anything is going to feel relatively chintzy, kind of cheap. This, not so much. It feels great. They didn't just launch that, though. They also have a new MacBook Air. This is $1099, and it's generally the same kind of layout that we saw in the prior MacBook Air. This is the 15-inch, but this time it's running Apple's M5 processor. That's its most recent in-house chip. It comes with 512 gigabytes of storage. That's an upgrade, which is kind of how you can zhuzh it to say that it's really not a price increase from the $999 last year. Overall, it's still the same great MacBook Air that you would expect. You have the ports over here, obviously, as well as a MagSafe charger. Over here, you have Touch ID as well for logging in. Great keyboard, great touchpad, and up to about 18 hours of battery life Apple is saying. So it's going to get you through the day, no problem. This now is the big daddy of the group, a new MacBook Pro. This starts at $1699. This is the high-end computer that you would be using for AAA games or for developing. It's now running the M5 Pro and M5 Max processors. Really, if you're going to get this system, you already know that you need a lot of horsepower, and you've been eyeing this probably for some time. Similar design to last year's version of the Pro. Basically, it's all upgraded internally. So you're not going to notice too much from the outside. Overall, if you need a computer that really has the oomph necessary to do things like compiling lots of code or doing a lot of heavy video editing, this is going to be the computer you get. Oh yeah, and don't forget, they also launched the new iPhone 17e. This starts at $599, similar price to the Mac Neo. And the big thing about this is that it's meant to be an affordable entry into the iPhone ecosystem. Now, it's $599, that's $200 less than the standard iPhone 17. You do give up a few different things with that price change, though. You only get one camera around the back rather than two that you would find on the iPhone 17. Up front, you also don't have that dynamic island that you get. Overall, this is a very good device, but those trade-offs are going to be a serious consideration for a lot of people, especially when it's only a $200 price difference. What it really comes down to is what you want out of your phone. If you don't really care too much about having two cameras and you don't really care about the dynamic island, then there's no reason to not get the 17e. But if those are things that you really do want, then I would go ahead and upgrade with the 17.
Stocks ending the day in free fall. Our very own Jared Blickery has those latest headlines. Jared.
Thank you. The tape is not looking good here. Let's dial up the Wi-Fi interactive. I will begin with the Dow, down about 700 points or 1.5%. And you can see we have closed at the lows of the day there. That's never a good sign. Here's the NASDAQ composite down a little bit more, about 1.8% or 400 points. Not quite the lows of the day. We hit those early in the opening 90 minutes or so. S&P 500 is where I've been focused. I was talking about trying to get through that 6,800 level. Well, we lost 67 today, 6,700 today, closing at about 6,672, down 1.5%, also closing at the lows of the day. And I want to show you a 2-year chart. I was just noting an interesting technical development for you who are into moving averages. We got a cross of the 50-day under the 100-day today. The last time that happened was almost exactly 1 year ago to the day. It was March 11th of 2025. We were down 9%. That happened, and that was before the big Liberation Day sell-off. So history doesn't repeat, but it can rhyme. So moving on, let's get to the sector action. We got energy to another record high, the 15th record closing high of the year, the first in a few sessions. Utilities also closing green. What did not work the most today, industrials. Industrials, I think, had the worst day in about 11 months, down 2.5%. Consumer discretionary close behind, tech close behind there, and then healthcare and financials all down more than 1.5%. And here's the NASDAQ 100. Not a lot of green. If you're paying attention in the upper right, we got Walmart, kind of a safety trade there. So is Costco green, but not a lot in between there. We got Tesla down 3%. All the other mega caps down over 1%, sometimes 2%. Looks like Microsoft off a little bit less than 1 actually. But let's drill into the software space, and you can see all the red there. Salesforce is an exception, up 2.5%. PanW, Palantir also in the green. But then semis, a lot of dark red here. So semiconductors have been a source of strength sometimes when the market is selling off, but not today. Pretty grim there. So I will probably close here on the Dow. I mentioned Walmart before, also seeing Chevron, that's that energy trade. Salesforce I mentioned, Travelers also in the green, but Boeing down 4%, that's the industrial trade leading the way down. So is 3M down 4%, and then Goldman Sachs off 4%. Financial is one of the worst performing sectors of the year. So not a lot of green in the market today, Josh.
Jared, thank you. Appreciate it. Well, for more on the latest market action, we have Rob Conzo here. He's CEO of the Wealth Alliance. Rob, good to see you. So a tough tape today. Rob, red just across the board here. Let's just start there. What do you make of it, Rob?
I just think, unfortunately, the word uncertainty, which was the word of the day in 2025 with the Trump tariffs, is now just become to the forefront. And it's showing up in so many different areas. When you looked at labor going from 56,000 jobs in December, then in January, 126,000, and then down to another negative 92. It's just a tremendous amount of volatility. The VIX going from 15 up to 30 plus, down to 25. Oil going from 56 up to 116, down to 78, and then back up to where it is now, 95. There is just a ton of uncertainty, and it's coming out in many, many different ways, including the bond market.
So to your point, Rob, we don't know what the impact is on the macro because we don't know how long the war lasts. We don't know how long the oil disruption lasts. So as an investor, Rob, your clients come to you and they ask, how do I navigate that? What do you tell them?
That's a great question. So when you look at what's going on with oil, obviously sitting around 100, obviously very, very inflationary, and that comes out in many different ways. From a Fed perspective, what are they going to do in July? I don't think they're going to do anything in March, but in July, are they going to pull back rates because of that? Maybe. Inflation, could that affect and have a negative effect on the bond market? Well, you're seeing that right now, right? The yield went up from 3.9 to 4.2. Bond values dropped. And that's happening because the bond market is signaling inflationary pressures due to this oil. So as this market continues, you could see fallout in the bond market. You can see bond investors, the 60-40, getting nervous, moving out of bonds, which would be an error. But they could see that. And on the equity front, that coupled with what's going on in big tech, the investor doesn't know where to hide right now. And the last thing that the investor wants to do, or we're telling him don't be emotional. We will get through this, but you got to ride out the storm and maybe put money to work where markets are dropping.
Rob, what do you think the Fed's role here is? Here's the President Trump today. Here's what he posted. I don't know if you saw this. He said, "Where is the Federal Reserve Chairman? Too late Powell today," he says. "He should be dropping interest rates immediately," all caps, not waiting for the next meeting. What do you think, Rob? Is the president right?
Well, listen, for me to try to predict what the president's going to say or is he right or wrong is a very dangerous place to be. But I will say that the president continues to hammer Powell with the same message: drop rates, drop rates. And to the Fed's credit, they've remained independent. And I think they'll continue to remain independent going forward. As far as dropping rates, we have remained data dependent. And right now, the data, especially on the jobs front, going from positive 126 down to a negative 92 in February, with the BEA changing its methodology on how it's calculating these numbers. And then you have the strikes with healthcare. It's very hard to pull something from that. So what is the Fed going to do? They're going to hold steady and wait till they could get a little bit more clarity on this data. And I think I don't feel anything's going to happen in March, but in July, you could see a rate cut if you continue seeing cracks in the labor market.
Rob, great to have you on the show today. Thanks for your time. Appreciate it.
Thank you.
Housing costs are often a person's largest monthly expense, but could some of those bills associated with your home actually offer you some relief on your tax bill? Join me now as part of our Write It Off or Nice Try segment presented by H&R Block is Andy Phillips, H&R Block Vice President of the Tax Institute. Andy, it's good to see you. Let's start here with one I'm sure is a top of mind for a lot of folks. Can I write off my monthly mortgage or rent payments?
Hey, thank you for having me, and that's a great one to start with. So that one is generally a nice try when it comes to just writing off your full mortgage or your rent payment. There are like a few states that you may be able to deduct some of your rent if you meet certain requirements, much more the exception than the rule. But what you may be able to deduct is if you're a homeowner and you're paying mortgage interest, you may be able to deduct your mortgage interest if you itemize your deductions. If you made energy efficient home improvements to your house, you may be able to deduct those. But one of the changes made by the One Big Beautiful Bill that passed last year was that those deductions are only available for energy efficient home improvements through the end of 2025. If you're self-employed and you work out of your home in an area that you use exclusively for business, not like just your TV room, but an exclusive area, you may be able to deduct some costs. So there are some situations where you can deduct some home expenses, but generally the answer is no.
All right, here's a second one, Eddie. How about this one? What if I move to a new place? Can I write off some of those expenses?
Yeah, that's another one that's a nice try. You used to be able to deduct certain, unreimbursed moving expenses, but following first it was the passage of the Tax Cuts and Jobs Act and then made permanent as part of the One Big Beautiful Bill, is only active duty military members who have moving expenses related to a permanent change of station are the only folks that are able to deduct moving expenses at this time. Again, if those or another thing those folks may be able to take advantage of if you're an active duty member is if you have reimbursements for some of those moving expenses, you may actually be able to exclude those from income.
Third one here, Andy. If a homeowner makes improvements to their house, my friend, can those costs be written off?
Another good question. Generally, that's a nice try, right? And so I talked about, the energy efficient home improvements that are only available through the end of 2025. Think about one, it's got to have that Energy Star label that it was a qualified piece of equipment to purchase and install. But two, it's only for certain things like certain windows, certain, heat or kind of, energy systems, insulation, things like that. So generally, no, you're unable to deduct the cost of home improvements. You may be able to get an energy efficient credit, which again is a credit, not a deduction, so generally more valuable, but only if you made that purchase before the end of 2025. There are some other things that you may want to think about when you make a home improvement. One is that if it's a capital improvement, meaning it's like a substantial renovation or something, you get to add that to your basis or your cost in the home, which helps to reduce any potential tax liability when you later sell that home. There are some other cases, like I talked about business owners. Here's kind of just an interesting and unique one, is certain home modifications that are medically necessary may be deductible. This is very much an extreme case, but there's an old court case from the early 80s where a guy was actually able to deduct a portion of the cost of an in-ground swimming pool because it was medically necessary. Don't rush out and build a pool. That was a very specific case, but kind of interesting that someone was able to take a deduction for a portion of the cost of a new in-ground pool.
How about clean energy appliance, Andy? Greener oven, right? More efficient HVAC, maybe solar panels on that roof. Can those purchases be written off?
Yep. As I mentioned before, if you made that purchase before the end of 2025, and you're looking at either is it like an energy system or more of like a structural improvement to the home, you may be able to claim a clean energy credit. Other than that, generally, those aren't going to qualify. The other key thing to point out is even for prior years, typical appliances that aren't, part of the structure of the home, like a dishwasher and we just had to get a new dryer, wish I could write it off, but those don't qualify for either year for that credit.
And finally, Andy, that new car, maybe some folks have in that garage, is that a write-off?
Generally, that's a nice try as well. A couple things there. One is part of the One Big Beautiful Bill allowed folks to deduct starting with purchases made in 2025 through 2028, the cost of interest paid on the purchase of a new vehicle. Of course, it's got to be new. It can't be a used vehicle, but you may be able to deduct some of that interest. You actually don't even have to itemize, but that's one thing you may be able to deduct related to that car. If you're like a business owner and you use a vehicle for work, you may be able to deduct certain vehicle expenses. Another situation you may be able to deduct vehicle expenses is if you have out-of-pocket costs serving for a charity. So there's kind of these situations where you may be able to take a deduction. I should also say sales tax on the purchase of a new vehicle. And then that annual property tax you pay may be deductible as part of your state and local taxes if you itemize your deductions, but there is a cap on that. For 2024 and earlier years, that cap was only $10,000. But for tax returns you're filing this year, if you're itemizing, most people are going to be able to deduct up to $40,000 in state and local taxes. That's those property taxes, including on your home or your vehicle. It also includes income tax. So a lot of people may be able to take advantage of that this year, and more people may be able to get a benefit from itemizing their deductions rather than claiming the standard.
Andy, one final one I want to squeeze in here. How about pets, Andy? I got a dog and 2 cats at home. Can they be a tax write-off?
I sure wish they could. Personal pets, no. I'll hit you with a couple quick ones. If it's medically necessary and prescribed by a doctor, certain expenses related to a service animal may be deductible as a medical expense if you itemize your deductions. Another one is for business owners, like the common example is like a guard dog for a scrapyard, but you may be able to deduct the cost of a guard dog for certain business owners. Another kind of interesting one is if you foster animals for a qualified charity, some of those foster expenses may be deductible as well. This last one is going to be only for a really narrow group, but for a certain, like a dog breeder, certain expenses related to that, because that's a business, are going to be deductible. But yeah, Fluffy at home, your personal pet, unfortunately, not deductible.
Andy, so great to have you on the show today. Thanks for your time. Appreciate it.
Thank you for having me.
Coming up, we're going to bring you Adobe's latest results. That's on the other side of this break. Time for a look now at some earnings as Adobe drops its first quarter results. Before getting the results, we got some big news in that company's C-suite. Shantanu Narayan to step down as this company's CEO. That is big news. Shantanu Narayan has led this company for a long time, 18 years, so a true veteran. Company saying he's decided to transition from his position as CEO after a successor has been appointed. Company saying here Narayan will remain as chair of the board. The board of directors has appointed Frank Calderoni, lead independent director of Adobe, as chair to the special committee to direct the process that the company says will consider both internal and external candidates. As for the results, let me bring you those as well. Q1 adjusted EPS 606. That's versus expectations is 588. Q1 revenue 640 versus expectations is 6.28 billion. Looking ahead, Q2 adjusted EPS, the company's calling for between 580 to 585. Consensus was at 570. And as for top line, Q2 revenue outlook, they're calling for between 6.43 billion to 6.48 billion. The street was closer to 6.43 billion. The stock lower here in the after hours, more than 5%. Remember, heading into this print, it was already down more than 20% this year. It was down about 40% over the past 12 months. The broad concerns for Adobe has been these AI disruption fears front and center. Analysts will highlight competition, especially at the low end, which they say does remain intense for Adobe. They'll call out names like Canva. Analysts also wonder, listen, what can be the near-term catalyst here that maybe get investors back into this name? There is, remember, the Adobe Summit coming up next month, and I know investors will wait and see what could be announced then. But again, big changes in the company's C-suite. Adobe's Shantanu Narayan to step down as Adobe's CEO. Well, for a closer look now at Adobe, let's welcome in Wolfe Research Managing Director and Head of Software Research, Alex Zukin. Alex, I want to get to the results, but first, your reaction to Adobe's Shantanu Narayan stepping down as CEO. What do you make of that news, Alex?
Look, we've seen a lot of CEO transitions in the software space over the course of the last few months. People coming back, people stepping down. So I think it's obviously a bit the timing. You never know when it's going to happen. But and Shantanu is obviously a legend. But I can't say I'm shocked. I do think that we've been kind of expecting something like this to happen for some time. Obviously, unsure of when that was going to take place. But I think it's right now it's a really unique time in the market, and you have to kind of get to a place where the next 3-5 years is something you're signing up for in these roles, and you're doubling down. So I do think that Shantanu has had a legendary voyage and journey here, and I'm not shocked at it, I guess.
Who would you like to see take that spot, Alex? I mean, maybe don't give me a name, but what's the resume? What's the experience you'd like to see?
Yeah, look, I think that they certainly have some internal candidates, like David Wadhwani, who runs the Creative Cloud part of the business, that I think is someone that I think investors have thought could be a potential successor for some time. I think the alternative is maybe getting someone from a younger generation that's maybe a little bit more thought of as AI forward or AI native to come. It could be another type of candidate to think about, but I don't think I would be a little bit surprised, I guess, if it came from the outside. Maybe somebody that used to be at Adobe that left could come back and take that role. Someone like a Scott Belsky comes to mind, but again, I'm thinking off the cuff a little bit.
So Alex, let me ask you, this stock's been clobbered by AI disruption fears. You're a bull on the name. How do you frame the debate?
I think the debate is how much can Adobe change itself for the AI era, where on the creative side, they can embed with their customers, help their customers tune specific models to accelerate the pace of content creation and content personalization in this AI era, and that how can they deploy agents and redefine a company's marketing stack and their data layer in order to deliver that content in a super personalized way to drive more impressions and more transactions to occur. I think fusing those two parts of the business and making them a way to deliver some of those outcomes rather than just a tool that someone in creative is using or someone in marketing is using. I think that's the path forward for Adobe. And I think they're well positioned with the right assets to be able to make that happen. I think it's been, it's harder and slower than in an enterprise context than in the small and medium-sized business, but I think they're well positioned to do it.
What would get investors more excited about the name, Alex? Like, what would it take to draw people back in? Is it a big new AI partnership? Is it big jumps in, AI monetization, total ARR? What do you think they're looking for?
I think they're looking for accelerating growth. I think any product momentum that can drive both in the core creative or experience part of the business, whether that comes from consumption packs or Firefly Foundry, that ability to really tap into the labor TAM from a software perspective, such that the outcomes that they're delivering can drive larger share of wallet, things that their customers have been spending hundreds of millions of dollars previously with their agency partners. If Adobe can deliver some of those outcomes at an accelerated pace, driving accelerated growth, I think that's what would get investors excited.
What about Alex at Adobe Summit next month? What are your expectations there? You think any chance that we hear about some, material AI developments out of the company?
I would love to see and feel a little bit better about the agentic strategy, see more agents in action on the marketing side, and understand how Adobe's ability to be both a data layer, an orchestration layer, and even monetization opportunity around third-party agents that tap into all that coherent and cohesive data that Adobe has about their customers. That's what I would be looking for.
Final question, Alex, just kind of broad. I mean, obviously AI disruption fears have been front and center, rocking that software sector that you know so well. Do you look at that and think, hey, that's a fair, reasonable reaction, or do you think, no, it's become overstated here?
I think the debate is very reasonable around how these companies evolve in a world where people are doing the work to a world where 80% of the work is done by an agent or a machine. I think that's a reasonable debate. I just think that there's a lot of opportunities for these companies to benefit from that, both at the actual first-party agentic layer, so charging for agents, figuring out how to build those workflows for other agents to log into the data and absorb that context, the rich context these businesses have. Because at the end of the day, these are complicated systems from multiple pools of information, and these companies have the agency to deliver that confidence in the outcomes that these customers so badly desire. And I think they'll figure out a way to get their share of the pie.
So those are the potential opportunities, Alex. What are the kinds of software companies that you think may be at the most AI risk?
So I think specific tools that really are, not expanding the breadth of functionality. I think we've seen some companies potentially in the robotic process automation area, some in the kind of broad-based collaboration area, be potentially maybe disintermediated a little bit more than others. So I think that it's any company that really stays very much centric to the old world of delivering a tool for just basic human use, I think is potentially at risk.
Alex, great to have you on the show today. Appreciate that instant analysis. Thank you.
Thank you, guys.
Coming up, we're calling in for more tech support with Dan Howley. Stay tuned. Hello and welcome to Asking for a Trend. Palantir unveiling several AI deals, including one with Nvidia, while CEO Alex Karp tells CNBC that his company still has its strategic partnership with Anthropic, even as the Defense Department designated Anthropic, we know, as a supply chain risk. To break down all the headlines, we're calling in for tech support with Yahoo Finance's Dan Howley. Dan, let's start there. So Palantir CEO Alex Karp, he's confirming to CNBC today, yes, we're still using Anthropic's Claude, despite that startup being blacklisted by the Pentagon. I don't know. I don't know if that was like super surprising. I know I'm not a Department of War IT guy, but I would imagine. I mean, that's when big changes are made. It's not like you just flip off a switch. There is a transition period. It does take some time. Here's what Karp said exactly. He said the Department of War is planning to phase out Anthropic. Currently, it's not phased out. Our products are integrated with Anthropic, and in the future, he said, it will probably be integrated with other large language models. What do you make of that?
I think it's a good way of hedging. Basically saying, yeah, we're not ditching it yet. We got 6 months to kind of scoop it out and dump something else in there. But if we don't have to, we don't have to. So I think obviously the U.S. has got various conflicts ongoing right now. It's using reportedly Anthropic's tools with the conflict in Iran. And so, I think just pulling that out right now, probably not the best thing to do. And so, I imagine going to continue to use this as long as they can until they really do have to start buckling down and saying, okay, let's take this out. We'll find another provider and put that in there. But I do think that they're also potentially hoping that we get a resolution to this somehow, and the Pentagon is able to continue to use Anthropic's capabilities. Anthropic is sued. President Trump has said, get rid of it from the entire administration. We'll see what happens. 6 months is a long time. We could just end up where Anthropic just quietly continues to stay on U.S. platforms, and they don't make a big deal of it, and the U.S. government just says, all right, no, whatever.
We'll wait and see. Let's turn to another one. AI agent tools, particularly one from the company Perplexity called Personal Computer. All right, so this one, it sounds like Perplexity wants to be more than just, an answer engine. So it launched Personal Computer. So this is described here as a new AI agent tool that can turn a spare Mac into a locally run AI system. So in simple terms, Dan, is this an AI agent that's on my computer, and is it sort of just working for me like a 24/7 digital assistant? It's
like having a dude work your computer for you, right? Yeah. I mean that's literally what it is, right? And we're seeing more and more of these agents come out. There's OpenClaw, which originally was ClaudeBot, and before that it was, or after that it was, I think it's MoltBot or MoltBook. I can't recall. There's so many different names. It's insane. But it is available right now, and it's an AI agent that you set up. You can run on your own. Setup's not exactly easy, but it will do things on your computer for you using various apps, whether that's WhatsApp or even Spotify, things along those lines. That's what we're seeing more and more of. This is basically doing all of that on a system-wide scale. And then you could log into it from different devices, so you're able to tell it, okay, figure this out on my Mac, get back to me later with the results. And it'll do just that. We're going to continue to see more of this kind of agentic workflow, which makes me hate myself to say that out loud, because it's such...
Not only to say it, but to understand what it means.
Well, yeah, it's just like, more corporate jargon, but whatever. We're going to continue to see that over time, just as agents become less of a, what can we do with these things, and more of concrete products. I think for most people, OpenClaw is still difficult to use, right? Yeah. You'll hear a lot about it in trade publications, different sites like us, where we'll explain it because it's a big thing right now among developers. For regular folks, it's not there yet, but eventually it will be, and you'll be able to tell your computer, do this for me real quick without having to click through a bunch of different menus. It's like stick versus automatic in my head. I like to drive a stick just because I feel like I'm actually in control. I like to be able to click the app to open it because it gives me more feel of control. So, I mean, to each his own.
Here's the CEO of Perplexity. Let me run this quote by you, all right? talking big. It says the product here could help a single person build a billion-dollar company by overcoming the single biggest disadvantage people have. You know what that is? Sleep, Dan. It never sleeps, he says. It's personal and more powerful than any AI system ever launched. Hype, reality, some mixture of the two?
I think that, people are probably also missing an idea. They're also probably missing huge amounts of funding, connections. Sleep.
A few other variables.
Yeah, sleep is, by the way, important to be able to do any of that, interact with people. So yeah, I mean, that's obviously setting the hype up, but the idea is seemingly sound. And I think that systems like this are very interesting just because, it's almost like the star trackification. Notch that in there, by the way. We're going to start using that term instead of agentic, star trackification of all of this, right? Like it's a computer, do this, run this diagnostic, and it would do it on its own, right? And you don't necessarily, sure, Worf was back there tapping all things for the engines and Data's doing whatever he's doing. But, you could still tell the computer to do what you wanted to do. And I think that's kind of the idea behind all of this. And it will make things, I think, more useful for more people just because you won't need to fully understand the back end. It's almost as though the computer itself and the interface that we know today becomes the back end, and the front end is just this agent.
Final one here. The Verge is a good piece. I was interviewed by an AI bot for a job.
Yeah.
And it's basically, this is about companies using AI, conduct interviews, ask questions, analyze responses, and companies saying, listen, we use these systems, they can be more objective, they can reduce bias, we can interview a lot more people. What do you make of that trend?
I think it's something out of a dystopian hellscape.
So you're neutral.
Yeah, I'm neutral. I love tech, right? But I think that in certain situations, it's not useful and can be harmful, right? AI has been shown to be biased. The Verge's piece points this out. AI is built by people. Your biases, it's also based on what's online.
It's feeding on experiences and resumes, right?
Right, so it's built on the internet, and the internet has, guess what, a lot of bias. And so that's an issue in and of itself. There's
a bias-free system sounds tough to
no, and you could look at facial recognition has had all sorts of issues with people with different skin colors or different genders. It's a minefield, right? You already have your resume fed into AI, which what a humiliating experience that is in general. Just throwing it into the void. At least if you could give it to someone in person or send it to a direct email, you would have the closure of the person being like, great, thanks, and putting it on a pile. But this is just the ether, right? Yeah. And you never see it again.
Do you think, I was thinking too, do you think you could learn how to figure out how to game the system?
100%.
Like, all right, I'll practice with some AI interviewers, I'll learn what they like, what they don't like, what they respond to.
Sure, I think that's 100% a possibility. I think though, if you're applying to a company, and look, at some point, I'm sure we'll start to see this more and more, but imagine you've been struggling to get a job for months. It's not easy to get a job in the market as it is, and now you've sent in your resume, it's disappeared. Oh wait, you finally got an email, and now you got to talk to an AI. Yeah. So it's just like a bigger slap in the face, I feel.
Do you think, though, a final question, I was thinking the same thing, but then I wondered, I initially was like, wow, I'd feel so weird talking to a chatbot. But then I wondered, is that an age thing, a generational thing? And maybe my kid, many years from now, when she's interviewing, be like, that was weird that you talked to a human.
Yeah, Ethan Wolfman, our newsletter editor, did a piece a long time ago explaining how if you curse at the phone tree, it'll get you through to an operator. I do that all the time because I don't want to talk to a phone tree. I don't want to talk to an AI then, right? Like, I don't like the phone tree, folks. Don't fake being a person to me. I think this is one of those cases where human-to-human interaction is a lot more important than how can we optimize this? By the way,
maybe you would end up hiring just people who are good with chatbots.
Yes.
That doesn't mean it's the best person.
Right. You could actually try to set an AI up to talk to another AI and then come in and say, oh, no, that wasn't me. That was my AI. But if you guys are going to do it, then I'm going to do it too.
Fair enough.
Yeah.
That does seem fair. Dan, thank you. Appreciate it. Stick around. Much more Ask for a Trend still to come. That's totally true. Airlines getting hit with dual headwinds here. TSA agents are calling out as they face their first week without a paycheck amid the partial government shutdown. Plus, rising oil prices means massive spikes in jet fuel. Julie Hyman spoke to an independent aviation specialist about the state of the industry.
Man, talk about sort of a 1-2 punch here. We've got the higher fuel prices. We've got the sort of partial government shutdown that's making lines at airports long. But okay, I want to talk about the fuel prices first. We know that airlines hedge, but I can't imagine that they can hedge this level of, volatility in the jet fuel market?
Absolutely, Julian. Thanks for having me. So one thing I would point out is the airlines in the U.S. are really done with hedging. Of the majors, Southwest did hedge in the past. They ended that program. So if you look at the last time we even had something even close to this in the energy markets, maybe one would look at 2022 with Russia's invasion of Ukraine. And when we look back at that example, what was the reaction in terms of airlines, let's say, naturally hedging through price point? That's not something they can do overnight, and it takes time. So I think the two questions for me: one, how long does this turmoil last in the energy markets? And two, what do we get in terms of individual airline demand curves that start to offset the higher prices?
So in other words, and leaving aside, we'll talk about the TSA stuff in a minute, but there has been some concern that because of the war that there's a drop in demand. Certainly we've seen a lot of rerouted flights,
no doubt,
in the Mideast region. So when, what does that look like from a demand perspective? I guess that's one of your questions. Like, well, how, does some of that get delayed? Does it get moved? Does it just get canceled and then people don't rebook it?
Yeah, great question. So I think in terms of what happens there, first one has to sort of look at where the individual airlines are flying. So if we think about global travel versus domestic travel of the US pack, let's say United Airlines probably has the most global exposure. So do we get some adjustments in bookings to places like Dubai and Qatar and even broader region, Tel Aviv, Athens, Istanbul? Hard to say. I would imagine, however, that those places, at least short term, are under some pressure. And there's some move by the consumer to, let's say, book travel to safer destinations or destinations that are perceived as safer. So if you look at the US airlines, for example, of the big three, United's got the most international exposure, American's got the most domestic exposure. American's international exposure is mostly southbound, which is a relatively stable part of the world these days. But when we look at the mix and the confluence of these factors, doesn't mean that there's no uncertainty for the domestic names, but it does mean maybe in the international side, we have a little less visibility in what the booking curve is going to look like in the next couple months.
What effect does all of this have on fares? And I was looking in CPI, of course, it tracks airline fares, and I was looking over the past several years, and we did see a spike in fares in 2022 when jet fuel prices went up. We have seen airline fares start to trend a little higher now as well. I saw in the report yesterday they were up 7% or so year over year. So do we see fuel surcharges starting to, like, how long does oil have to be elevated for them to say, we're going to put a fuel surcharge on the tickets?
Yeah, that's an excellent question. So I do think this at least somewhat looks and smells like 2022 when we had the oil price spike with the war in Eastern Europe. And what happened at that time? Really, you saw a mix of reactions on the airfare side, depending on the individual airline's demand curve. So if you're one of the big three, you've got business class, you've got international first class, you've got economy plus or equivalents. Folks with relatively less demand elasticity, you can start raising fares now. Maybe if you're a discount airline that has very little or no flow in those categories, it's a little bit of a tougher tale because of the demand elasticity from main cabin and basic economy. But if you look at 2022, fares went up. You saw the big three raise fares. And I think the good news from that episode, oil thankfully didn't stay elevated for that long. You saw yield, the airline price point per se, how much ticket revenue do they generate per passenger mile flown. You saw yield increases sequentially for 4 consecutive quarters, outpacing the sequential increase in jet fuel kerosene. So you actually saw that economic spread widening, which helped them recoup the early stage when oil shot up and damaged everybody. So do we see something similar this time? I would imagine with the big three, the answer is yes. I think if you're a Southwest Airlines, you're no longer hedging fuel. You've made some big changes in your main cabin. Time will tell how resilient that demand curve is versus the others.
Interesting. Okay. What we didn't have in 2022, well, we probably had a government shutdown. I don't know. It feels like an annual event. But what we've been seeing in terms of the delays going through security at a lot of major airports, does that also, affect demand? Because if I'm looking at that and I'm on the fence about a trip, maybe I'm going to drive instead of flying if I can.
Absolutely. And I think that's one of the things in the current scenario that's a little bit hard to quantify. Is there a risk to demand from some of the backups at the airport? Absolutely, that's something that didn't help. So we had a 43-day shutdown in the fourth quarter, and the airlines reported, for example, that there was some earnings impact from that. So throwing that in the mix at this juncture is certainly not helping things. And I think within the space itself, there is some true economic impact built into stock price. I would also argue there's some emotional impact built into stock price. So when we do get this calming effect, hopefully relatively soon, all else equal, I would imagine some kind of snapback from a share price standpoint. But certainly, demand shutdowns, temporary global entry shutdowns, that doesn't help.
Stick around. Much more As for Trends. Don't go. Time now for To Watch Friday, March 13th. Wall Street is in store for a hefty batch of economic data, starting with that key PCE report. The Fed's preferred inflation gauge expected to climb 0.3% for the month of January and remain steady at 2.9% year over year. Core personal consumption expenditures, thus excluding food and energy, are expected to tick higher on a year over year basis from 3% to 3.1%. The Fed, of course, will keep a close eye on the inflation reading as the central bank gears up for its rate decision next week. Investors widely expecting the Fed to hold interest rates steady amid uncertainty around the impact of higher oil prices. Also on deck is a fresh reading on consumer sentiment. Economists expecting preliminary results to show a decline in sentiment, dropping 2 points in March compared to February. Currently, sentiment is about 13% below a year ago and 21% below January 2025. Lastly, we're going to get an update on GDP. The U.S. Bureau of Economic Analysis will release the second estimate for the fourth quarter. Revision for U.S. gross domestic product is expected to remain the same as the advance estimate released last month. That's a wrap on today's show. Thanks for watching.